Coming up today, Microsoft tanks after releasing earnings. Crowdstrike tumbles further. Can megacap tech find its footing here? Did we really see the top in NVDA? A look at all Q2 earnings, global macro data, a preview of what to expect from the Fed tomorrow, an update on commodities, and Bill Ackman backpedals his IPO. Hey, what's up guys? Welcome back to the Click Capital Daily Market Review. We just got another mixed day on Wall Street. Still getting a bit of a rotation out there, with megacap tech and semis trading really heavy today. S&P 500 overall still trading a bit heavy. Still haven't quite got into these oversold conditions just yet. But we are seeing a big divergence in the performance of sectors underneath the market today. Coming out in front was energy, utilities, and staples, lagging way behind technology and consumer discretionary weak as well. Just looking at cross-asset performance. Bouncing back today, precious metals, gold and silver, along with commodity complex REITs, and of course down the bottom, Nasdaq and Bitcoin a bit weak today as well. Mega cap tech as a whole still holding up somewhat, definitely getting tested here though. Market breadth still holding up, same with stocks hitting new 52-week highs versus 52-week lows. Volatility staying well bid in this market, with the VIX just underneath 18. Still got heaps of data and earnings to get through this week. Option dealers still priced in the 9-day higher. Government bond yields still under pressure. It's a 2-year at 4.36. We'll get to hear from the Fed and Jay Powell. 2:30 tomorrow afternoon. Market will be really looking to confirm how it's been trading lately. Really expecting him to come out in a somewhat dovish stance and indicate a rate cut in September. Got short-term bonds trading firm going into that. High-yield bonds still holding up good. Bitcoin having a bit of a low-volume pullback. And there's a look at gold creeping towards all-time highs. Made just a few weeks back under $2,500 an ounce. Silver's still got a little bit more work to do. And crude oil getting a bit oversold here, just above $75 a barrel. Semis got whacked today with NVDA down over 7% on pretty big volume. However, having a pretty good bounce here after hours as I speak. And stick with me today because I'll come back later and I'll show you what's driving that. First, let's just take a look at the leading story today, and that was earnings from the second biggest stock in the market, Microsoft. Have been trading down for a few weeks going into it, and I'll get into the numbers soon. Here's a look at the after hours action on the 5-minute chart. Sold off really hard straight away, 7.6%, actually getting down to $3.89 a share. It's actually bounced up a bit, currently trading at $4.07, down 3.6% as I speak. And so just looking underneath the hood at the numbers. Earnings per share up 10% to $2.95 in the quarter. Pretty much what analysts had expected. Same deal on sales. Made a whopping $64.7 billion in revenue in the quarter. That was up 15% from a year ago. Cloud revenue up 21%. However, investors were hoping for a little more. And I think what really got them worried, probably their most important business that investors are really focused on for now and the future, their cloud business Azure, with them saying they expect growth to slow in the current quarter. And it's just amazing, these mega cap tech companies still growing their cloud segments 20-30%. Just wonder how long that can go on for. They're still committed to a huge amount of capex. That's good for the knock-on effects to those that they're spending that money on. It's good news for NVIDIA. They're also expanding their team, building out their research and development department, still growing the Windows business. And so just going back to the daily chart on Microsoft, did put in a pretty good bounce. And this is why we use technical analysis, because it literally bounced off 389, almost hitting the nail on the head from where it bottomed out in its last quarterly earnings result. And so it's a pretty swift move, down from 470 down to 390 for what just was the largest stock in the market. And again, technically speaking, we'll be looking for this support zone to be defended if it does get retested in tomorrow's regular session or the coming days. Because if an important stock like Microsoft were to lose its support, that could have broader implications for the market as well. Helping the situation right now and to get a bounce in semis, we just heard from AMD, forecast better than expected results for its September quarter, raised its annual forecast for AI data center GPU revenue, reported second quarter earnings per share 69 cents, beating Wall Street estimates by a penny, same with revenue, and that was music to the market's ears. AMD currently up 7.5% after hours and getting a nice little bounce here after it had been beaten down pretty hard the last couple of weeks, going from almost 190 down to 130, helping to give the overall semi sector a bit of a bounce too, up 2.3% after hours as I speak. It too testing this big level of technical support on the chart. It's really kind of a bit of a make or break technical point of time here for mega cap tech semis. If they want to keep this strong parabolic trend intact, sure, it may lose the support and bounce back. If that trend gets broken, it's more likely to go into consolidation phase and continue trading a bit heavy, especially when you look at that hard run up in the spread of the Russell 2000 small caps versus the Nasdaq. Just been an explosive move. 1, 2, 3, 4, 5 momentum thrusts on the upside on huge volume. A lot of money coming out of tech and into small caps of late. Got a few other key stocks reporting today. Starbucks, worse than expected sales. A few consumers pulling back on 7 $7 Frappuccinos. Revenue fell around 1% year over year. Same-source sales fell 3% globally. You adjust that for inflation, it's even worse. They're on a cost control mission, which is doing better than expected, becoming more efficient, making the business more lean. They are under activist attack from Elliott Investment Management, built up a stake in the company. They can quite often create a bit of volatility in the stock price, as the activists often put pressure on the board, the CEO, to either change strategy. Sometimes it can result in departures, and sometimes the activists can turn it around. And I'd say they'd be putting the pressure on to unlock some value, as Starbucks has been trading really weak, especially this year. Started off trading just under $100 a share. Here we are today, closing at 75, just popping up a little bit after hours on earnings, technically trying to find a bottom here. Also got Crowdstrike still in trouble after that massive historic global tech outage a bit over a week ago, when apparently they left a bug in an update, caused half the world to come to a grinding halt. Now got report that Delta Airlines might be potentially taking some legal action against them. Could see a few others join suit. And what initially looked like a week and a half ago was a big buy the dip from the market, it actually lost its footing right away, trading super heavy here on a lot of volume. Just a month ago, trading at $400 a share. Here we are, getting closer to being cut in half. And this just shows you why investing is difficult, because you can have a great stock like Crowdstrike, fundamentals and technicals, some of the best you'll see out there in the market. Super fast, smooth growing company, and then out of the blue, something unforeseen, completely out of our control happens, and the stock gets whacked and almost cut in half. That's why you got to be diversified. That's why you got to have a stop loss, and it's why you got to look at support and resistance. The market can give you clues. For example, here around 285, the stock had found support twice before. Looked like it tried to do it again, then cut clean through it, taking it more than 30% off its highs. A new fundamental risk, and I'd say a lot of big money has followed the same thought process and just looking to sit out on the sidelines. Whether it bounces back or not, you can just take this risk and bad performer out of your portfolio. So like I said, big tech stocks being tested here, at least technically. Earnings and fundamentals still pretty good, just the gap with small caps is narrowing. Still got a few more to get through. Apple, Amazon, Meta, NVDA in another month. That'll be an interesting one. I'd expect them to knock it out of the park, as they're the biggest beneficiary of all this spending. All these big companies have to turn all that hardware into a profit. But just because the fundamentals are doing well doesn't mean the stock can't have already topped out. Stock market is very forward looking. Oftentimes it can see a change in the fundamentals 6 to 12 months in advance. Like I always say, technicals lead, fundamentals follow. We are getting some heavy price action in NVIDIA, even though we're bouncing after hours now. And wouldn't it be funny if NVIDIA did top out on June 18, when it briefly passed Microsoft to become the most valuable public company in the world? Eerily similar pattern we saw in Cisco. Also briefly overtook Microsoft for a day or two back in March 2000 before it topped out and fell more than 90%. Some people say this was the moment when NVIDIA topped out. Around the same time, they briefly overtook Microsoft. CEO Jensen Huang. However, there's always two ways to look at everything. Contrasting that view is comparing the current AI revolution to that of the internet, and using the launch of the first web browser, Netscape, back in December 1994 as the mark in the sand, versus the launch of ChatGPT, the first mainstream AI chatbot, in November 2022. Kind of similar pattern in the NASDAQ performances between these two eras. Some of you watching may have even remember Alan Greenspan, then Federal Reserve Chairman, noting the market is trading on irrational exuberance on December 1996. Going down to the bottom chart, no better way to illustrate how crazy markets can get when you've got one of the most smartest minds in finance, Alan Greenspan, calling the market irrationally exuberant way back down here, only for the market to go on and triple over the next 3 years. So it'd blow a lot of people's minds if we did the same thing with AI and semi-stocks again as this. At the end of the day, nobody knows. That's why we follow the trends first and foremost. Others aren't as confident. We've got one economist saying the market is flashing signs of a dangerous debt bubble with losses that could be contagious, potentially spreading losses in the financial sector. This economist warns of overvalued stocks driven by enthusiasm for AI, highlighting the danger of highly leveraged, unproductive asset. Well, all that sounds spooky, however, I'm not really seeing much numbers to back this up. And from data I've seen, leverage on Wall Street, small and large traders, is nothing like 2007, especially capital requirements for banks, how much risk taking they were taking back then, their trading desks. It's a whole different world. Banks are a lot more well run, a lot more safer. They don't have all this subprime mortgage. There are risks in the commercial real estate sector. However, the Fed's already got in there and pretty much backstopped them. They've learnt from the GFC. They're not going to let that happen again. And remember, we now live in the era of massive artificial monetary stimulus from the Fed. Big companies and markets are simply not allowed to fail. On the other hand, we've got some suggesting the current bull market will extend into next year. According to Ned Davis Research, they expect to remain overweight equities, with the correction leading to a buying opportunity. And just looking at their historical chart of global stock price index during cyclical bulls within secular bull markets, exactly like we are now. The mean performance here in the black line, pretty strong and up to the right. And here we are on this green line here. It's tracking a little bit below mean based on the length of this bull market. Also got Fundstrat saying a bullish signal for small caps is flashing for the first time since 2009. So the Dallas Manufacturing Survey shows a sharp spread between the current and forward expectations. Lee said such spreads historically preceded significant moves in small cap stock. He thinks they could have a really good August, and he expects them to continue outperforming going into year end, with the tailwinds being huge valuation gap that's closing and the expectation of interest rate cut. Also got Morgan Stanley coming out saying investors should buy industrial stock as a valuable market driver deteriorate. Citing earnings revision breadth has deteriorated, but industrial stocks are still uniquely positioned to outperform. And overall, so far, as we approach the halfway mark in Q2 earnings season, coming in about average, a little bit better than average when it comes to the percentage of companies beating on EPS, 77%. Average surprise, 4.5% is pretty good. Looking underneath the hood, we're getting the best beats from consumer defensives, basic materials, communications, financials, and energy, along with the defensive sectors doing really well. Still got a few more to get through, but so far so good on the defensive stuff. And I'd agree with the sentiment and view from Bank of America in their global research note today. Rotation is where the action is. Neutral on the index, bullish on internals, elevated downside risk in coming months. I'd agree with that. We've been a bit overdue for a pullback. August and September can be a seasonally weak period, and then right around the corner after that is the US election. You see an elevated VIX for a few more months, but also a full-fledged bear market is unlikely for the here and now. Still a real possibility we'll get that next year if we get a recession. But for the here and now, the consumer is hanging in there. Consumer confidence ticking higher in July, coming in at 78.2, up from 72.8 in June. Consumers have slightly higher expectations for future income growth, even though they've gotten a little bit less positive about current labor and business conditions. Over to global macro, we've got bond yields still trading a bit heavy here. Got the Treasury Department lowering its third quarter borrowing estimate to $740 billion, down more than $100 billion from its estimate 3 months ago. It's a little bit supportive of lower yields, but the big one is the Fed meeting tomorrow and the interest rate decision. Widely expected they'll stay on hold, but we're looking for some indication from Jay Powell that he's going to cut in September. That's what the market's really banking on. Some people say there's a chance he may even cut tomorrow, and while we can't ever rule anything out, I would be very surprised. So with the market, and typically he doesn't like to rock the boat and surprise markets that much unless he really saw something worrying that warranted urgent action. Otherwise, I think he'll open the door for a potential cut in September. We have seen the jobs market softening. Global central banks are trimming. The bond market seems convinced that he's going to start cutting soon. Signs of inflation have been coming down of late. Commodities are a bit soft. I think all the ingredients are there for him to trim 25 basis points. And he also may have had a bit of a heads up on the jobs report we're getting this Friday. Bank of America forecasting the US economy will have added 225,000 jobs in July. And the real interesting thing in financial markets going on for 2 years now is the huge inverted bond yield curve, where we've had short-dated bond yields above long-dated bond yield. Basically, the bond market forecasting weakness down the track. And typically that's a strong indicator of a recession around the corner, and the most of the time, the stock market won't bottom until during or after the recession. And just looking back in history, the average time before a recession starts after the yield curve inverts is around 14 months. So a bit over 1 year. Here we are now, 24 months, now tying a record from back in 2005, 1967, looking highly likely we're going to go 25 and above. So we're now on historical records for how long the yield curve's been inverted, and who knows? This could go to 30, this could go to 40. We will eventually get a recession. But at what point is it too late to say, well, the inverted bond yield curve was right, we did get a recession? Is it 30? Is it 40? Is it 50? And again, no indicator's 100% right, and who knows, maybe this is the 5-10% of the time when it didn't really get it right. But for clues on this, we'll be watching the unemployment rate. If that starts spiking, then it's almost guaranteed we're going to get a recession. Just on the commodities, got oil pulling back again today. Still not hearing the best data coming out of China. Global investors really looking for their economy to start accelerating again, as they're expected to make up about half of all the oil demand growth in the world this year. Moving on to Bitcoin, a little bit soft after the Bitcoin conference in Nashville, Tennessee. Looked like it was on its way to all-time highs. Appears to have pulled back just here. There has been news, potentially the Biden administration selling its Bitcoin, that it's been confiscating. We did hear Trump come out, says he wants to turn the United States into the crypto capital of the world. They'll never sell their Bitcoin, and adds a whole new dynamic to global financial markets, US dollar currency reserve system, and just fiat versus cryptocurrencies in general. So for the here and now, still looks to be tracking a bit sideways, above $66,000 a coin. And I'd say now the price of Bitcoin has a bit of a bet on the US election embedded into it, as Trump is likely to be a lot more bullish for crypto in general than what Kamala Harris will be. Just moving on, billionaire hedge fund manager Bill Ackman is looking to bring his fund to the market with an initial public offering. He's had to dial it back quite a lot. Was hoping to raise $25 billion. However, he's now looking for around $10 billion. Where he was looking to monetize his growing popularity on social media, become a bit of a celebrity on X, really speaks his mind, not afraid to criticize anybody. He's hoping to turn that popularity into dollars. He did have a fund listed over in Europe, traded at a heavy discount for a long time, crept back, and so we're still yet to see how his fund's going to go, but I'll keep you guys updated. There's a look at the economic calendar today. Got some GDP data coming out of Spain, a little bit better than expected, and same with France as well. I trust everyone is enjoying the French Olympic Games. Same with the Eurozone overall. A little bit better than expected on GDP. And there's the JOLTS job openings in America. Better than expected results, along with consumer confidence. Just about to get a bunch of data from Australia soon. Retail sales, CPI, inflation. Then in a few hours, we'll get to hear from the Bank of Japan on their interest rate decision. They're expected to stay on hold at 0.1%. That's the root of all their problems right there. Going out tomorrow, we'll get more inflation, data from the Eurozone, ADP employment change from the States, and then the Fed press conference mid-afternoon. Like I said, we'll be really looking for Jay Powell's language, whether he's going to let us all know he's about to cut rates in September or not. Because like I said, the market is pretty much convinced and pricing in more than a 25 basis point cut in September. 0% chance that they'll still be in hold, and just a 4% chance that they'll cut tomorrow. On Microsoft as I speak, just going into the end of the post-market session, down 3%, $410 a share, covered some of those losses. The other key mover, AMD, still up almost 8%, holding on to those gains going into post-market close. And these are two stocks we'll be watching tomorrow. AMD currently trading just below 150 here on the chart, and Microsoft currently trading 410 around here on the chart. It did get down to here just a couple hours ago before it bounced. But make sure you come back to the channel tomorrow. We'll be diving into Meta earnings after close, what sort of move we get out of that. Then on Thursday, we've got Apple and Amazon, and then remember Friday, jobs report. So big week, and we've still got a lot to get through. Thanks very much for tuning in with Click Capital, and I hope to see you back here again tomorrow night. Cheers.